Welcome to Prosperity on the Horizon, the podcast that transforms businesses through the power of numbers. I'm your host, Julianna, your financial storyteller and strategic bookkeeper, and my job is to help busy business owners and entrepreneurs just like you understand your numbers and the story behind them. This is episode 65, answering your burning questions about cash flow, pricing, and business finances. Welcome to Prosperity on the Horizon. I'm Julianna, and today I would answer the most common burning questions I get these days from my clients, from business owners I meet in other circles. I know that business finances can feel overwhelming and stressful, but they don't have to be. I'm answering some of the most common questions I get, questions that keep so many business owners up at night. So if you've ever thought, why does my profit and loss statement say that I'm making money, but my bank account has a totally different story? Or how much should I be paying myself? Or how do I stop feeling stressed about money? Then this episode is for you. Let's start with the most burning question of all. Why does my business look profitable on paper, but I never seem to have enough cash? This is one of the biggest frustrations business owners have. Your accountant may say that you are profitable, but when you are staring at your bank account, what you see is, where is all the money? The thing is that profit and cash flow are not the same thing. Profit is what's left after you take your revenue and subtract your expenses. And cash flow is about timing. It's about when the money actually moves in and out of your account. Let's say you sign a $10,000 project. Your profit and loss statement will show that revenue, but if the client hasn't paid yet, your cash is still low. So on the flip side, you might pay $3,000 upfront for a yearly software subscription, and that cash is already gone, but because it's considered a prepaid expense, it doesn't show as an expense all at once on your profit and loss statement. So you've already spent that money, but your P&L still shows a greater profit because that $3,000 is not yet an expense in your accounts. If you want to know where it is, it's on your balance sheet under prepayments. So what can you do to have a better picture of where your business is at? You can track cash flow separately from profit. Look at what's actually coming in and going out, not just what's on paper. And also keep an eye on payment terms and overdue invoices. If clients are taking 30 to 60 days to pay, that's affecting your cash flow. So you want those payment terms to be shorter. You can also forecast upcoming expenses, what bills, what subscriptions or tax payments are coming up. Make sure to plan ahead because it will help you avoid cash flow surprises. The goal is not to just be profitable on paper, but to actually have cash available when you need it. Another question I often get asked is, how much should I be paying myself as a business owner? This one is tricky because many business owners fall into two extremes. Either they pay themselves too much, leaving their business strapped for cash, or they barely pay themselves at all, taking whatever is left after business expenses. But there is a better way to think about it. Treat your salary like a business expense, not like an afterthought. A simple way to do this is to think about it from a profit perspective, which means that you can allocate a percentage of your revenue to owners' pay, for example, just like you allocate for taxes, operating expenses, wages, and so on. A common target is around 50% of net profit, but it depends on your business. Another option is to set a fixed salary, which is based on your personal financial needs and, of course, your business revenue. If you are not sure where to start, look at your monthly revenue trends and set a consistent amount instead of just taking out random amounts when you need some cash. This helps you create financial stability in your business and also in your personal life. And here is another common question. What's the best way to manage inconsistent income as a freelancer or service provider? When you don't have a steady income that you can rely on month by month, managing cash flow feels like a roller coaster. Some months you are flush with cash and other months you may struggle. So here is how to stabilize your income. First of all, build a buffer fund, which you can do by setting aside money during high income months to cover expenses during the low income months. Aim for at least 3 months worth of expenses in a separate business bank account. You can also set up predictable revenue streams by offering retainers or subscriptions or payment plans so your income comes in regularly instead of all at once, then nothing. You can also pay yourself a consistent salary, even if your income fluctuates. Move a fixed amount from your business to your personal account every month. When you plan ahead and organize your income, you can balance between months where you have too much money and others where you don't have enough. So following up on the previous question, I often get asked, how do I create an emergency fund for my business? First off, the reason you need to think about this is because if an unexpected bill, a slow month, or late paying client could wipe out your business, you need a financial safety net. An emergency fund gives you breathing room so you are not scrambling for cash when something unexpected happens. And here is how to build one. Start small. Aim for 1 month's worth of expenses first. Open a separate business savings account so you are not tempted to dip into it. Allocate a percentage of every payment into this fund. Even 5% makes a difference. Keep building it until you have 3 to 6 months worth of expenses saved. Having this buffer will definitely reduce stress for you and will give you options when the unexpected happens. The last question that's related to profitability and cash flow, and I may answer a few more in an upcoming episode because I can tell you there is a lot more. So, what financial reports should I actually be looking at each month? Most business owners only look at their bank balance on their phone, which is not a financial report, but also that doesn't give you the full picture. If you want to stay in control of your finances, there are 3 key reports you should check every month. Number 1 is your profit and loss statement. This shows your income, your expenses, and whether you are making a profit. Look at trends, which you can do by looking at your figures in the current month and in the previous month. And by trends, is your revenue growing? Are your expenses creeping up? Then the next financial statement to look at is the balance sheet. This tells you what your business owns, what's yours, and what you owe to other businesses or other individuals. It includes cash, outstanding invoices, loans, credit card balances, also GST, payable superannuation, prepayments if you have those type of things. And then the third main report to look at is your cash flow report. This tracks your actual money movement, what's coming in and what's going out, and it helps you see if you have enough cash to cover your upcoming expenses. You have to look at all 3 reports, not just pick one. If you are not sure how to read these reports, ask your bookkeeper to walk you through them. All it takes is a quick monthly check-in, which can help you make better and smarter financial decisions. Let's move on to some pricing and profitability questions. A very common one, how do I know if I'm undercharging for my services? Many business owners set their prices based on what others charge or what they think clients will pay, rather than on what they actually need to cover their costs and make a profit. And here are some signs that tell you if you are undercharging. You feel overworked, but still struggle to cover business expenses. Or you take on too many clients just to make ends meet. Or you feel resentful or burnt out because you are working hard but not seeing enough reward. Clients rarely question your prices. This often means that you could be charging more. So how to fix it? First of all, know your costs. Make sure that your pricing covers your expenses, your time, and also your profit. Compare your value, not just your price. Are you offering more expertise, better service, or a more personalized experience to your clients? Because if so, you should be charging accordingly. You can test with some small increases. So raise your prices for a new client, for example, and see how they respond. Your price should reflect the value you provide, not just the time you spend. The next question is, how do I raise my prices without losing clients? Raising prices can feel really uncomfortable, but it's necessary. It is a necessary step in growing a profitable and sustainable business. And here is how to do it without pushing clients away. Start with new clients first. If you are unsure, increase prices for new customers before applying changes to your existing ones. Give existing clients notice. Let them know ahead of time, explain the value they receive, and assure them it is a business decision to continue providing quality service. You can also offer options. For example, if a client can't afford the new rate, which is not the case most of the time, but they will object anyway. In cases like this, consider tiered pricing. For example, you can reduce services instead of keeping the old price, or the other way around, offer them VIP treatment for the increased standard rate. And be confident. If you are providing great results, saving clients time, or making their life easier, then your pricing should reflect that. Most people won't leave anyway just because of a reasonable price increase, especially if they trust you and see the value in your work. The next question is, what's the difference between revenue and profit, and why does it matter? Well, revenue is all the money you bring in from sales. Profit is what's left after you pay all your business expenses. For example, you charge a client $1,000 for a service. This is your revenue. Then you spend $300 on software, subscriptions, and other costs to deliver that service. Your profit is $700 because that's what remains after the costs. So why does it matter? Because revenue alone doesn't tell you if your business is actually making money. If your expenses are too high, you could be making sales but still not keeping enough for yourself. This is why tracking profitability, not just revenue, is very important. All right, the next one is very specific to each type of business, but I get asked this a lot. How do I calculate my service prices to make sure that I'm actually making money? To price your services correctly, you need to make sure that you cover the followings: your costs. This can be software, subscriptions, team members, supplies, training, and so on. Also, your time, how many hours it actually takes for you to deliver your service. And of course, your profit. What do you want to make after the expenses? So here is a very simplified step-by-step pricing calculation. Number one, add up all your business costs, your monthly expenses like software, marketing, office supplies, and so on. Decide how much you need to pay yourself to live comfortably. Then estimate how many hours you work per month and how many clients you can handle. So this is also capacity planning. Then set your minimum price. If a service takes 5 hours and your minimum rate is $100 per hour, then that service should cost at least $500. Then don't forget to add your profit on top, so you have money left to grow your business. If your prices are too low, you will work too much for too little. So make sure that you are charging enough to run your business without burning out. I think this is going to be the last question for today. What expenses should I be tracking to make sure that my business is profitable? To understand if your business is making real money, you need to track your fixed expenses, your variable expenses, and you also need to track your own pay and your taxes. So what are fixed expenses? These are your regular costs. These are the ongoing costs of running your business, like software and subscriptions, accounting tools, scheduling apps, project management, and so on, your rent or co-working space, and your website hosting and domain fees, for example. Next, look at your variable expenses. These change as your business grows. these costs go up or down depending on your workload. And they can be contractor or freelancer payments, payment processing fees for like Stripe or PayPal, marketing and advertising, and so on. Then you also need to track your own pay and your taxes. So make sure you are paying yourself properly and set aside money for taxes, for superannuation, and business savings. And just a quick note on how bookkeeping helps you with all this. If you track these expenses properly through bookkeeping, you will always know if your business is actually profitable, not just bringing in money. And just a few final thoughts before we wrap this episode. These questions cover some of the biggest struggles business owners face with cash flow, paying themselves, and staying financially stable. Understanding pricing, expenses, and profitability isn't about overcomplicating things. It's the opposite. It's about making sure that your business is set up for success. So remember to charge enough so you are not just covering your costs, but you are actually making money. Keep track of where your money is going so you can stay profitable. Review your pricing regularly. What worked last year might not work now. If you take one thing away from this episode, let it be this. Your financial success isn't about working harder. It's about managing your money smarter. So what is one financial change you are making this month? Send me a DM or come and join the Intentional Entrepreneur community on Facebook. I will add the link in the show notes for you. I would love to hear from you. If any of this felt like a light bulb moment for you, let me know. What's one thing you are going to change about your pricing or your finances after listening to this episode? And until next time, stay intentional, stay ahead, and keep making smart financial decisions.